Mark Gray, Chairman CEO of Allegiance Coal, ASX listed company with 2 producing mines in the US, a development project in the US, and a development project in British Columbia, Canada. We are very much focused on the production of metallurgical coal for supply to the seaborne steel market.
Mark, good to see you, sir. I think we saw you at the beginning of November. I wanted to catch up. One, because your quarterly came out recently. I want to talk about revenues, recruitment, and real estate. But before I do, I want to talk to you about the market. Okay, coal, slightly out of favor. It's a dying industry. It's all doom and gloom. I'm not sure investors should be interested in it. What's your view?
Well, of course, whenever we talk coal, we've got to make that distinction up front between thermal coal for power generation and coking coal for the blast furnace steel production. In actual fact, both as sectors are doing extremely well. We, of course, are met coal, coking coal focused. I'm not in touch with the thermal market as much as I am with the coking coal market. But as far as metallurgical, steelmaking coal, coking coal is concerned, we continue to enjoy fantastic prices. Demand in our sector remains strong. It's not just a China story, interestingly. India is the biggest importer of seaborne coking coal. Europe, coming out of the COVID doom, where we saw steel production reduced by 70%, is increasing its demand again, and blast furnaces, which were idled during that period, are coming back online. So demand remains very strong. But I think the difference between this boom, if you like, and previous booms is supply. It is seriously constrained. There was a lack of capital investment by the major resource houses since 2013, which was the decline in the sector, the last decline in the sector. And that has caused a severe lack of forward supply. In the past, you could always rely on BHP, Rio Tinto, Anglo American to have a $2 billion project on the horizon, which would deliver an additional 10 to 20 million tons a year. You could expect one of those to happen every 5 years. They don't exist anymore. New supply is coming from people like ourselves, the junior sector, and we don't bring 10 to 20 million tons to the market. We bring 1 to 2 million tons to the market. So supply is having a huge influence on pricing. And that's the difference in the macroeconomic scenario of our sector at this particular stage. So our sector is strong. The opportunity to generate powerful revenue and significant profits is as good as it's ever been. Yeah.
Okay, so let's have that adult conversation here, because I'll start with slightly amusing story. Okay, we went to commission an illustrator to work for us to create an illustration for an article we were producing. Yes, they said, no problem. Okay, tell me a little bit about what the article's about. Oh, it's about the coal market. Oh no, I couldn't possibly do an illustration for the coal market. That's just dirty, polluting, and damaging across the board. We're not doing it, right? So that's the mindset I want to talk to you about, right? That's an illustrator. You've also got the same mindset with lots of big funds all across the world, right? And so therefore, it's not just people who perhaps should know better but don't, but should know about this as part of their investing thesis, but still get confused between thermal and coking. Have you experienced that? Because I know I have.
Yeah, it's funny you mentioned that. We had a similar experience very recently in relation to our Black Warrior property in Alabama. We were undertaking a semi-industrial Co-Coven test of our Black Warrior coal to determine its coke strength. And it was a large sample, 1 ton sample involving many drums. We reached out to the major courier companies to move that material from Alabama to Germany, where the Co-Coven was. That material sat for 2 months. No courier company would pick it up and take it simply because it was coal. And when we reminded them that this wasn't thermal coal for power generation, but steelmaking coal, for a blast furnace, they looked at us dumbfounded. It's an unfortunate situation. The ESG debate is failing to acknowledge the distinction. There is a unwillingness simply because of the word coal, and I'm well aware of a very significant investment bank who is very active in the resources sector and historically in coal, who simply will now not touch it. So in
its broadest context, whether it's thermal or coking, it's verboten.
Full stop.
Okay, right. So
these are intelligent people.
These are intelligent people.
Yeah,
but it's your job to educate them, or at least for them to explain why they won't. So I think the argument basically is around thermal coal for heating is perhaps polluting, and does have some very damaging stats associated with it. You're talking about coking coal, which is used in steelmaking coal, some people call it, to make the stuff which makes airplanes, for instance, cars, housing, shipping, everything, all of those things. So there's a kind of disconnect between of thinking or chains in that thought. But that's the challenge ahead. So I'm trying to work out, is that terminal because we'll never get there, or what's the market looking like now? Like, for instance, is the demand still there?
As I said at the beginning of this particular conversation, the demand, short, medium, and long term, is strong, and coupled with constrained supply, the sector, bodes well for the long term.
But what's happening with the pricing? Because last time we spoke, obviously prices were heading up. You talk about the quality of coal that you guys are pulling out of the ground and sticking on boats now with positive revenue generation. But I'm interested in what's the price, what's the margin, what's the sustainability at those levels and those margins.
Well, none of us have crystal balls, so we can't guarantee what the price is going to do over time. Currently, and certainly for the last 12 months, we're enjoying extraordinary prices, the highest that they've ever been in the history of seaborne coking coal. It's quite extraordinary. Can these prices sustain? I don't know. The opportunity is there now to make fantastic profits. But I can only believe that in one form or another, pricing will certainly remain robust simply because of the macroeconomics of strong demand and, more importantly, limited supply.
But what is the data? What are the data points? What are the analysts saying? What are the banks saying? What are the fund managers saying when they look out in this space? Or are they all just avoiding this space and looking elsewhere? Where's the data come that says, look, the demand is overwhelming. We will continue to need coking coal, steelmaking coal for the foreseeable future, but because the big boys, the BHPs, the Rios have stepped away, it's going to be in small increments of 1 to 2 million tons, versus what they would be coming into. So those give us confidence to go and raise capital to, for your OpEx, to raise money for acquisitions. So what can I look at to give me that confidence?
That's exactly what the coal analysts are saying, and the research houses who are active in this sector. That is exactly the story. But projecting prices forward, you'll never see an analyst project current prices medium long term. They will always anticipate a decline down to what they believe is the marginal cost of production, and where the price must survive in order to sit at or above marginal cost of production. So you'll always see that. But the theme is exactly what you say, and that certainly creates a lot of interest in the equity capital markets. On the debt side, we face the same ESG concerns. And as I mentioned before, there was quite a major investment bank in the sector who will no longer touch coal. So it is becoming increasingly difficult on the debt side. And you are really looking at private equity houses, credit funds to provide debt capital, which obviously comes at a greater expense. But the equity capital markets, certainly in our experience in this sector, remain strong.
Well, that's where it's going, and you kind of beat me to it with regards to the cost of money going forward. Because if public-facing groups cannot look at, touch, speak about coal, people will take advantage of that, and the cost of money will increase. But you're now throwing off cash, right? And in the context of what we just spoke about in terms of being able to plan forward in terms of margins, etc., is your Q4 numbers were not what you told me they were going to be. Is there something we need to know?
So I missed a vessel by a couple of weeks. It loaded 2 weeks late, so I missed. I think I had indicated to you that December quarter revenue would be in the order of $25 million US. We banked 8. Had my January vessel loaded on time, we would have been in that vicinity in the 25. That revenue, nonetheless, is banked for January, along with the other cargoes that we have. So we have about US 32 million sold, revenue sold, and to be delivered in this quarter. So that's a significant, step up in revenue since we, put these assets together. Our September revenue was 1.7 million US. December we stepped up to 8, and this quarter will be greater than 30 million revenue. So yes, we are. We're generating cash now, and it is. With our production pipeline, it's foreseeable we can maintain it, and we're starting to focus now on cost so that we can, capture that margin and profit.
Right. So remind me, if you're going to be, in Q1 on guidance, what's the number for the year that you're guiding in terms of revenue, first of all? So
I haven't provided an annual revenue guidance yet. I'm still.
Is it going to be flat? Let me ask you another way. Is it going to be flat? Okay, Q1 30. Are we looking flat, or is there a kind of growth component to this story?
So this year, our sales production guidance annualized will remains the same of about 1.6 million tons of saleable coal. I think we'll get there 3 months later than I had anticipated, with New York not ramping as quickly as we would have liked.
Why not?
We spent the December quarter realigning our underground layout, our 2 mains which we operate, to provide more efficient production, short, medium, and long term. We completed that exercise. All the while, we have finally broken the back on building our workforce. We were stagnant at about less than 50 underground operators for for 3 to 4 months. We had very much a revolving door. For every 3 or 4 guys that turned up, 3 or 4 had left. It's just about maturing the workforce and getting it settled.
So why were they leaving? Was it work conditions? Is it why?
Combination of factors. The most influential of which was accommodation. The area where our New Elk mine is located in southern Colorado has limited accommodation, and the vast majority of our workforce were in motels, and that's not sustainable, medium to long term. During that period, we have increased our portfolio of houses, of leased properties in the area, and we now have 50 properties under our control. So we've been able to take a lot of people out of the motels and get them comfortably housed in the region. With the influx of workers in January after New Year, the motels are filled up again, but we do have a pipeline of more properties becoming available over the next couple of months. So we'll work to get those workers comfortably housed as well. But we're now up. Our total underground production workforce is around about 75. That's a significant step up from 45 before Christmas. That puts us in a position now where we can operate 2 underground production units, both with a day and a night shift. It's 4 shifts per 24-hour period. So we will see increased productivity from New Elk this quarter, and particularly with the realignment of our underground mine plan. So I think, New Elk will start to make significant contribution to our revenue this quarter.
Okay.
For the rest of the year.
And so just be clear about, want to get the terminology right, revenue versus net profit. I want a sort of sense of, you talk about the efficiencies that you're driving, and the engineering will, help with some of those efficiencies. But, and that's about reducing the cost of production over a period of time. No problem with that. Are you making money today?
On a group basis, yes. Black Warrior was a ramp up. It was a ramp up of an existing business which was already making money. But we will triple production this quarter from Black Warrior with the same fixed costs. So unit costs will go down and our margin will increase quite substantially. In addition, we're now selling a coal which would have otherwise fetched $80 in the domestic thermal market. We're now selling that on the seaborne coking coal market for prices in excess of $250 a ton. So Black Warrior is doing extremely well. New Elk is a ramp up, is a startup, and we've got to remind ourselves that by the middle of the year, I expect New Elk to be on its own to be cash flow positive. It's a big mine. You can't run it with a small workforce. It's got a big wash plant. It's got big infrastructure. You have to staff that mine as if it was producing 1 to 2 million tons a year. Once you achieve your productivity and drive your unit costs down, it will start to generate a good margin. And I expect that asset to be in that position by the end of the June quarter this year.
Okay, and when will you kind of start giving guidance on numbers? Is it a case of each quarter you'll review and assess what you see and talk to the market about that one, or are you looking at 2022 differently and say, look, we need time to kind of get these efficiencies in place, and we'll let you know next year? I mean, how's this work?
Yeah, sure. We'll update our production guidance in the next 2 weeks. Just want to see how New Elk goes this month with the arrival of the workforce. We also, we were also battered quite bad in January with COVID, as most businesses and industries, not only in the US but globally. We were no exception to that. But that's washed through, and we have very few COVID cases in our workforce now. With the arrival of the additional workers, I want to see how the productivity improves in this month of February. And at the end of this month, then I'll be in a position to provide a production guidance which I think is accurate and reliable. As far as EBITDA guidances are concerned, we won't do that. I don't intend to do that until Q3. We need to achieve steady state production. We're still testing Black Warrior as a premium high vol A product. I have a trial sample to a large European steel mill, 20,000 ton sample, which we're loading next week. If we're successful with that trial, then we can expect to achieve high vol A pricing, which is $380 a ton, versus a discounted price that I paid for a trial sample.
Okay,
if that is successful, we know we can achieve benchmark high vol A pricing, and I can therefore forecast reliably because I know that the product has been accepted. I have no reason to believe it won't. We completed large Co-Coven tests on this coal. We know it's good quality hard coking coal, and that it will sooner or later command index-based pricing.
Okay, so as an investor, I want to know how to play this, right? Because if I look at your share chart, you're up sort of 10 cents over a 12-month period, and it's kind of gone, it's fairly kind of erratic pricing, share price movement out there. Coal companies, the bigger ones, tend to produce as much cash as their market cap each year. It's kind of insane. You get no value almost for your assets for the work that you're doing. However people value coal companies is a mystery to me. So how do we look at a company like yours? Are you going to be producing cash to make acquisitions, to dig more coal out of the ground, drive revenue, in which case, I don't know where the growth component is if you're going to keep plowing it back in the ground, or, do we at some point expect dividends from companies, like yours? And again, the big boys are dishing out high single digit, low double digit numbers. So, what is this investment story that I should be buying into?
Quite a few points in what you just asked there, Matt. The first one is that certainly the EBITDA multiples that coal companies trade on are significantly lower than other resource companies. It seems to be a reflection of this particular boom, so to speak, or this particular period. I think what you see, and certainly our strategy, is to focus on paying dividends as soon as we have the retained earnings to do that. I have no intentions of doing any additional acquisitions. We've got a great portfolio of assets. We have our Black Warrior mine, which is starting to produce fantastic revenue for us. New Elk is in its startup phase, but halfway through it, and has got an excellent runway over this quarter. And then, of course, we have our Short Creek underground asset, which is a world-class tier one, mid-vol hard coking coal, with what we anticipate to be relatively modest capex. So I aim to bring that into production the second half of 2023. And then, of course, we also have a nice asset here in northwest British Columbia, where I live. So we've got an excellent portfolio with low to modest capital demands. Our focus is very much to build retained earnings and pay dividends.